Hello, everyone. I'll, I'll let people gather together. We should get started. I'm Apurv Saxena. I am, as a conference co-chair, it's an honor for me to welcome you to day 2 of our conference. This is our 3rd annual conference. And each year, it's amazing, and I'm astonished at the quality of the content, the quality of the speakers, and quality of the sponsorship has kept on increasing. Even though I've been in this field for some time, each time I sit on in the sort of audience, I get to learn so much. This whole field of AI is progressing and developing in such fast pace that you get to learn something new every time. And that spirit of learning is what drives this volunteer-run organization to come together to participate and put this amazing show every year. So if nothing else, let's put our hands together for all the volunteers, 50 plus or 100 plus every year that we have a huge, who come together to put this conference together. In that spirit of learning, I wanted to summarize some of the things that I learned yesterday. The opening remarks from Ilya was eye-opening, especially if you remember the zoom out of how much compute has gone into building some of the new algorithms and some of the early new wins in AlphaGo, in orders and orders of magnitude larger than some of the early wins, and which reinforces the point that AI is as much about data as much as about compute power. The other thing that I found very interesting was the whole conversation around AI in finance. Now in my newer role at JPMorgan, I could relate to it. But the 2 things takeaway I got from was using AI for alpha is not as easy as it sounds for a lot of techies like us. Number 1. Number 2 is this dynamic between deep domain expertise in AI and econometrics models is something that we all have to, the beautiful piece or the biggest advances will be when we merge both of these together. And in the afternoon, Kai-Fu Lee, who is like a legend in this space and a superstar in China, that's what I hear each time he's more famous than a lot of the celebrities in China. I think what I learned from that was we could not take the innovation engine that's powering AI in Silicon Valley for granted. China is increasingly catching up fast. The pace of innovation is, in fact, faster in a lot of ways than Silicon Valley, and something all of us to remember as we innovate globally. And for me, the last one was at the business banquet, a talk from Jay Agnick, my former colleague at Google. All the hype that happens in AI, I think he so eloquently put how he sees progress in AI and where AI is today, in comparing it where photography was in its span from 1936 all the way to 200 years of development. And his positioning was AI is where photography was in early 1830s. So we are still very early in this area, but the rate of progress and the rate of innovation is staggering. So it took 200 years for photography to come where it is. I hope it takes less than 200 years. And his prediction was in the next 20, 25 years, you will see amazing advances. So that was my learning. We have something similar lined up for today. We have this today. Yesterday was about the fundamentals, as Junling calls it. Today is about application of AI in various industries. So we'll start it off with application of AI in finance with Mellissa Goldman. I will give a little bit more details about that. Then we'll follow up with robots, AI in robots, drones, and AI in enterprise, followed by games and healthcare. In the afternoon, and we have done this every year, and it has been very successful for us, we will showcase some of the AI startups in this area. And this will be followed by a VC panel discussion where the VCs will give them feedback about the startup pitches. So that will form the day 2, and tomorrow is all about training. So let me come back to the keynote. It's a pleasure for me to introduce She's coming here for the first time and hopefully not the last time. Mellissa Goldman, my colleague, she runs machine learning and AI services for all of corporate. That includes risk functions, compliance functions, so on and so forth. She has been in the industry for a long time. Before JPMorgan, she spent 20 years at Goldman. And before that, she has a pedigree from Carnegie Mellon CS department, which is, again, one of the departments we recruit heavily on, or also a lot of the great researchers have come from. So without further ado, please welcome Mellissa Goldman on stage.
All right, so good morning, everyone. I think my job today is to talk about financial services, the kinds of things that are going on within the industry, within this sector, that are enormously exciting in terms of the impact that we can have both on the world and on our customers. My goal at the end of this conversation is to be as cool and as exciting as some of the stuff that I'm sure you're going to hear about the robots and the drones. So that is what I've put my goal as. So just to start off with, because we're reasonably new to this conference, I wanted to set the stage by talking a little bit about what we mean when we say financial services. It's not just the consumer bank that you're typically aware of, the Chase brand, the brick and mortar, the digital online experience of interacting with your savings account and your checking accounts, but it goes much broader than that. The financial services industry. It is the investment banking functions, those that serve our corporate clients, help them manage payroll and foreign exchange volatility. It is the asset managers, where you've heard about investment strategies and what we can do on behalf of investors within that. It is the VCs that I'm sure many of you are familiar with, as well as the private equity, and so on and so forth. The reach of financial services is immense, and it touches every part of the world with transactions that impact virtually everyone across the globe. As you can see on the slide, we make up about 1/5 of the global GDP. So the significance of this is seen in that, as well as how many trillions of dollars of currency is traded daily, as well as employing over 6.3 million people just in the US alone. So this is a far-reaching industry with so many opportunities. Some of these opportunities, though, are really around tackling some significant issues that we have, and they are in the socioeconomic space. So there are many, many people, almost 2 billion people in the world, that are unbanked or underbanked, meaning they don't have access to formal financial resources to help manage their money. We've got 61 trillion in debt globally. We are at a high in terms of the amount of debt creation that's happening around the world. Now, listen, not every debt or not every loan is bad, but to the extent that that keeps growing, it has impacts on things like unemployment and consumer consumption and so on. And so we really need to manage that carefully. And then finally, just to point out another area, which is in retirement assets. We are seeing more and more individuals who are unable to spend their retirements with secure financing because they have not been able to effectively save appropriately. So we, as an institution, JPMorgan, as well as all of the other banks in the world, really have an opportunity to help move the needle across many of the things around the world that are impacting us. In addition to those worldly kind of challenges, we also face challenges in how we want to serve our clients. And so across the board, over $40 trillion invested in funds today. How do we ensure that that is invested optimally, utilizing the right strategies, and really being effective and personalized around individuals? Things around fraud, there's over $22 billion in fraud losses annually. And we'll talk a little bit more about what that means, but when customers come to us and utilize our services, the expectation is we are effective in our controls, in protecting their transactions and ensuring that we are doing the right thing both for our vendors as well as our individual clients. And then finally, we'll talk a little bit around the optimizations that are out there against current banking functions. As with many industries, you find that there are functions that can be more easily automated, allowing more focus on the higher value added activities. And we'll go through what that looks like as we apply some of the newer and opportunities to bring AI and machine learning to those functions. So how do we do it? At JPMorgan, we are in relationships with about 50% of US households in the United States. And so we have some kind of banking relationship with all of these families and homes. That could be a mortgage, that could be a credit card, that could be a bank account. We do business with over 80% of the Fortune 500 companies, and we operate our businesses in over 100 countries. And so what does that mean? It means lots and lots of data, lots and lots of information, lots of transactions, lots of activities that we can harness within those functions that we do. You can see there over 25 million credit card point of sale transactions daily. We look at 20.6 billion transactions monitoring over the course of a year, ensuring that we don't have fraudulent activities happening within the landscape. And the list goes on and on. These are just some samples of data sets that are out there that we can tap into. When we look at those data sets coupled with alternative data, we get even that much more opportunity and power to serve our clients and serve the industry. Bringing market data and all of the history around what's happened in the markets to be able to apply predictive analytics to portfolios and functions, to be able to understand the companies that we do business better by looking at publicly available financial statements and information and census data and credit scores. I mean, these are all activities that we do within the organization that when we couple these things with all of these data sets are enormously powerful in how we can affect change and opportunity and facilitate transactions in this space. These are not, well, some of these problems aren't new problems. Some of the problems are new problems, but many of them are kind of age-old problems that we've been dealing with. We've been applying model-based techniques within the financial services industry for decades. As Apoorv mentioned, I've spent most of my time within finance focused on the risk area, calculating value at risk, counterparty risk, country risk, different things that look at these risk metrics. So we're not new to data sets, we're not new to model-based calculations, but with the advent of what was mentioned, the incremental capabilities around compute and storage and memory, we have now more than ever the ability to bring a next order, a next generation of analytics and insights into this information through the techniques that you guys are all involved in and have been hearing about here at the conference over the last days. So we'll drill into them a little bit more. And so I mentioned our responsibility around helping to solve, some of the biggest challenges around these social economic issues, financial inclusion. How do we lower the bar for individuals to interface with our products and our services? And so we can actually take more information, more data around behaviors of the individual, things that they have access to, ways that they interact and operate, with the world in general, bring it together and be able to evolve products and concepts and capabilities to allow much deeper penetration of this into serving these clients that have historically been unable to attain access. On retirement security, the ability to evolve customized retirement portfolios to teach individuals how to bring their finances together, how to ultimately save and set themselves up so that they don't get to retirement age and find that they've had depleted resources. We not only understand the individual and how to customize around that, but also we can bring to bear value-related investing. So social investing for individuals that have needs around wanting to construct their portfolios very specific to what their value systems are. And then finally, on the household income side, what we've discovered is that many people live paycheck to paycheck. They are unable to absorb an acute event. Possibly an individual has been working, they expected to work overtime, they didn't get that overtime, they find a child that has a sickness, needs to go to the doctor, and all of a sudden they're behind in their payments. And so there are things that we can do within this industry to insert the kind of analytics, the kind of intelligence about the customer, the things that are going in their lives, to both help them adjust their strategy around cash flow management, but also then potentially provide loans or bridging capabilities into their lives with the comfort and recognition that they can manage the risk and we can manage that relationship. And so there are so many ways that we can really accelerate all of the change that we want to see within society, for that matter, in helping through the use of our data and our visibility within the financial services. We also want to deliver our client value. You heard, I think, yesterday around sort of chasing alpha opportunities there. Now, when it comes to understanding how we can respond to event-driven investing, historically, the way a lot of opportunity reveals itself is when events happen and we respond to those events. Something's happening with a company, it's part of a portfolio. How do you react and how do you respond to that? The way we know events are happening is, we have lots of research, lots of people out there that are looking across lots of functions. We can actually bring natural language processing to that problem space. We can surveil enormous amounts of information that's out there in the public domain and sort of bring that back so that we can filter out the noise and really identify what the most meaningful events are that would trigger an event that we need to respond to within a portfolio. As a result of that, we can be far more proactive around how we manage that and ultimately provide much greater value in extracting these investment strategies. We are doing that today in certain spaces, and that is extending to many other areas of how we think about managing assets within the bank. So I talked about credit card fraud. Mentioned it's over 22 billion from an industry perspective. I don't know, does anyone have experience with a transaction being denied? But yeah, exactly, right? Doesn't feel good, right? Doesn't feel good. You're out with a client or a friend, and the waiter comes back and says, hey, your card didn't work, right? That's not a seamless user experience. And so our responsibilities, right, is not about stopping every potentially fraudulent transaction. That wouldn't feel good to a customer, right? Because our behaviors kind of vary, but rather, how do you pick the sweet spot? How do you get more specific around finding those transactions that are really the ones that you want to stop relative to making it a poor experience of going too far and stopping too much? And so we have been managing fraud within the credit card businesses for a very long time. But the models that we use to do it are reasonably, you'd probably call them rudimentary relative to the capabilities that we now have. So whether it's leveraging only 100 attributes in 3.5 million scenarios relative to what we can do today, which is over 900 attributes in 10 million scenarios, we can actually detect different kinds of behaviors within how people are using their credit cards, where they might be traveling to do that, the kinds of things that may be going on in their lives. You have a child or a sibling, they're getting married, you're going to probably put different kinds of charges on your credit card than you otherwise may do under a different circumstance. And so some things that might look fraudulent in one situation, depending on what's going on in your life, may or may not in another. And so our ability to actually bring that data, bring that information in, run it through our models, ultimately run it through our self-learning models so that what we'll have is the ability to evolve these over time and with the changes in what an individual is going through to not only have the realization of those savings within the banking organization, which is estimated in the hundreds of millions from an industry-wide standpoint, but also make it a much more enjoyable experience for a customer or consumer to actually utilize that product and that capability. And then I'll touch on the efficiency item. And I don't think this is necessarily specific to banking, but because banking has been around for centuries, we find that there are processes in place that if we can bring the intelligence of an AI capability, a machine learning model, we can actually deploy resources to much, much greater value add kinds of tasks and activities. I listed one example here, which is really around our responsibility in publishing research. We have an obligation when we publish research to make sure that it's not inclusive of certain companies or tickers or firms that are on, we'll call it a specialized list. And so it's really important not to simply do what we've historically done, which is like text matching, right? Just pure text matching where lots and lots of false negatives, false positives will appear and need to be then remediated and looked at by thousands of individuals for that matter. But to apply sort of intelligence to that, intelligent entity extraction, understanding the context of how that particular entity is being referenced within that document. Once we do that, then we can take all of that guesswork, all of that reading and reviewing sort of out of the critical path. This is not only specific to our research activities, but it could be applied to other processes where we have large volumes of individual people reading through QA processes, QC processes, ensuring that we get the right outcomes. Another area where we see real opportunity is on some of the metadata extraction from our documentation. We need to run our processes off of what we're kind of legally obligated within our contracts. And so we have many people that look at these contracts, they extract information and data from them, they put them into our operational systems, and the opportunity to apply this NLP, this extraction to it is enormous in terms of both quality, what we could provide to the customer, and actually lowering the cost of doing business with the organization. So I took you through a lot of where the opportunities are, and this is only scratching the surface in places across the organization, both JPMorgan and the industry in general, where we are applying these techniques. But I did want to talk a little bit about the financial services sector, because if you haven't spent a lot of time in it, if it's somewhat new to you, there's certain aspects of it that make it, I call it interesting, some people might call it challenging, to operate, because we're dealing with a couple of different aspects. Now, the first one that I'll talk about is data privacy and security. And again, this is probably one that is not unique to JPMorgan. You see it all over the news around what our obligation is to our clients around utilizing our systems, our services. But it's really important to understand that the entire reputation of a bank is presided on the fact that we can safeguard assets, and those assets not only being those financial assets, but those data assets as well. And so if we are not safe and secure, our entire reputation is at stake. And so we have to be very cognizant of that. That comes into play in terms of where we physically put our data, how we treat our data, who gets to see our data, and at what point. Because within that data, we have very personal, materially confidential information, all right? We have not only personal information about individuals and the companies, but we also have information about their assets, their credit cards, you know, all the stuff that you, if to the extent that you are a Chase customer or one of our banking clients, would hope that we keep, you know, very safe and secure. And so how we use that, what we need to do to that data, obfuscate that data in terms of using it in certain contexts is definitely a focus of our work. The data use guidelines and policies, you know, the context and how and the business process and how we use data is constantly being reviewed. It's not only reviewed internally, but it's reviewed sort of externally by our regulators. And so it's not only the physical data itself, but it's also, are we using it in the right way? Are we using it in an ethical way? Are we using it in a way that if it's splashed in front of, you know, on the front page of the New York Times, we would be proud of that headline? And so we have to always be conscious of our data use, and we have policies within our organization, and there's definitely policies that are enforced across the regulatory environment. And then finally, just to highlight, the regulatory environment around data is changing all the time. I listed here the California Consumer Privacy, right? You guys, many of you who are living in the state of California, right? There's probably two angles in how you look at this, wanting to make sure that you own your data, it's treated correctly, it's treated as designated by these policies, and we as a user of that data as well need to be very conscious of that and ensuring that it's only used in the right context. The financial systems have been around for a long time, and in fact, in the industry, there have been a lot of mergers, acquisitions, combining of companies and different kinds of activities that have brought functions together and in some cases taken them apart. And so the environments that we find hosted in a lot of these financial institutions are far more fragmented than if you started up a bank today, how you would go about it. And so there's a lot of data corralling, data wrangling that happens, you know, within the organization. And historically, you know, we haven't applied the same kind of discipline to data that we have to some of the other processes. So we're a bit, I would say, as an industry, in some of that catch-up mode, making sure that from a data quality standpoint, it is fit for purpose and how we want to use it, and also investing in the labeling of data, because historically this hasn't been a very kind of front and center exercise because we haven't used the data in that way. And so there's catch-up that's happening on that side. I'd just like to point out reference data. And so when we think about, you know, who a client is, right, that client can be called different things in different parts of, you know, different banks, different functions within a bank. And so we're spending a lot of time around our strategy to converge our reference data. And it's not only a convergence of reference data, but it's also that reference data changes over time. When you have two companies that merge and they go into a third company or they combine into, you know, a single company, then taking all of the data that we had about that company and making it reference now, the new company or being part of another company, and also our obligation to be able to go back historically and make sure that we can still talk about that company as it existed 2 years ago. So lots and lots of investment within the organization around reference data and landing that correctly. We have to be careful, inherent biases, right? So, you know, we saw it on some of the recruiting sides. I mean, you could extrapolate that to many other functions. How do we choose to make loans and deliver, you know, credit facilities, you know, to organizations? We have to make sure that we don't simply use, you know, potentially, biased data that has been implemented or executed before in terms of how we think about going forward. And we need to make sure that the tools and the capabilities are there, that we get comfortable, that the underlying data that we're using to drive these calculations doesn't have that bias embedded in it. And then finally, there are many elements that we want to go after where the data sets are just not robust enough, that they're not big enough, that we haven't had the history around them. When we think about the credit crises that we go through, it's not like we've got millions of points to look back on around certain kinds of events. And so we have limited data sets, limited signals. And so continued investment in finding ways that we can actually get those insights, execute these capabilities while at the same time having constraints around some of the data sets that we have to use. And then finally, I think it's important to point out that because the regulators are very focused on ensuring the integrity of our processes around whether it be our risk management or other business decision-making processes, we have requirements that exist against our models around validation. How can we show that the model is working, that it continues to work, that we've got the evidence of its execution, that we can explain it to a regulator and also show its auditability. And so there are a number of things against our models that we are obligated to do to make sure that on an ongoing basis we can demonstrate that. As we move into some of these neural nets and hard to explain calculations, we find ourselves needing to invest further in model explainability and auditability, so we get the opportunity to have that leverage. And finally, because we have some of this model governance in place, the ability to change and the overhead in changing that is something that we are also looking to reduce, because we do want these self-learning models. We want to be able to change them over time. We believe the effectiveness of them working in that context will be to evolve them, and so making sure that we've got the right construct around that that's satisfactory to to our regulators is a component. Just also like to point out that in certain decision-making processes, we are also allowed to use some data, and also within the regulatory and the policy can't use certain bits of data. So using things like zip code and other parameters need to be out of play in certain loan decisions or extension of credit decisions. And so not only do we have to be conscious of certain data attributes that we need to exclude in calculations, but rather also implied those attributes that may be otherwise implied by some of the other data sets that we're using. And so again, it's not a limitation, but rather it's something that we need to be cognizant of, and at the same time work with our regulators to understand how we're actually getting this leverage and bring them on the journey with us as we leverage AI and machine learning in a far more significant way within financial services. So in summary, we are taking this capability enormously seriously within the financial services industry. There is absolutely broad desire, acceptance, drive within the most senior ranks of each of these organizations that are out there, JPMorgan specifically, to extract greater and greater value from the new insights and the ability to leverage data in the way described earlier. We've got over $10 billion of investment within the technology portfolio, which centers around our strategy of bringing data together and injecting it into what would be a machine learning, AI-centric philosophy as we evolve our businesses across the entire domain. We've got an organization that is both getting aligned in a lot of ways and driving this change. You heard Apoorv, and we're thrilled to have Apoorv at JPMorgan. I just wanted to call out a couple of other hires. We've also hired Yang, who has joined us from Facebook. And starting, I think, next week is Naren Chittar from Salesforce. And so even within those hires, you can see that JPMorgan explicitly is interested in upping our game and bringing to bear these capabilities within every business process that we have across our organization. And so I'll just end on great opportunities, both in the micro space of JPMorgan, as well as the macro socioeconomic opportunities to really help the broader industry and globe, for that matter, evolve. The scope and the scale of the data that we have underpinning this information is enormous and helps facilitate the capabilities that we're talking about building out here. Our global reach as an institution, touching so many people in so many countries and wanting to do even more of that through the evolution of our businesses. And finally, the breadth and connectivity allows us to extract insights that I think years ago could not even have been imagined. And so with that, I thank you for your time. I hope that at the end of this conversation, it will rival the robots and the drones that are coming up next. But certainly, financial services is an absolute exciting place to be as we develop the next generation of capabilities across AI and machine learning. And so, thank you for your time.